Most traders believe the hardest part of a chart is calling the bottom. It isn't. The hardest part is reading what happens after the bottom. Today we read one full cycle, a bearish descent, a true capitulation flush, the recovery that follows, and the moment that recovery quietly becomes the setup for the next leg down. The chart opens with structure already breaking. A bearish break of structure, a decisive candle closing below a recent swing low. Price never reclaims the level. There is no bullish reversal. The character has flipped to clearly bearish, and what follows is distribution. The descent that follows is textbook distribution. Lower highs, lower lows repeated. But notice the candles are not panic-shaped. No huge red bodies, no gaps. This is patient institutional supply being delivered into available bids. The urge to call a bottom here is exactly what gets punished. Then the flush. A single elongated red candle drives well below recent lows, prints a deep wick, and closes near its low. This is capitulation, the moment the last sellers exhaust all at once. Stops cascade below the prior low, and the panic feeds on itself. But capitulation is exactly what institutions have been waiting for. Now look directly below that candle in the volume panel. The bar there is dramatically larger than every other bar on a chart. That size is not just panic selling. It is institutional buying absorbing the panic at the same instant. This is the signature to internalize. Capitulation is identified by price and volume together, never by either alone. The candles that follow produce the first sustained bullish move on the chart. Price climbs, prints higher, lows, and breaks above the prior swing high. That first higher high confirms the capitulation was real. Institutional buying has not just absorbed the panic, it has driven price meaningfully higher. The character has flipped to bullish. The recovery climbs in clean multi-leg fashion, higher high, higher low, all the way back to the order block at the top, the same supply zone where the broader bear cycle began. The first touch prints a higher high right at the level with a notable upper wick. There is selling here, but not yet aggressive enough to reverse price. After a small pullback, price returns to the order block and prints a second high at almost exactly the same level. Two highs at the same price have a name, equal highs. They tell you real selling exists here repeatedly, and they are visible to retail who place buy stops just above the exact liquidity an institution needs for one more wave of distribution. The third approach is where the read becomes decisive. Price prints one more high at the equal high level, and then the next swing high prints below it. That lower high is the structural signal that distribution has restarted. 3 failed attempts at one level, then a lower high, is the institution telling you buyers are losing strength. Look at the volume panel through the late recovery. The bars are visibly smaller on both the up attempts and the pullbacks. Volume contraction while price tries to make new highs means the buyers themselves are exhausting. The institutional buying that fueled the recovery is gone, and the seller is about to return. The right edge confirms it. Price drops from the equal high level, past the prior higher low, and prints a new lower low, the first since the recovery began. The bullish character is gone, but structurally the recovery was over earlier at that lower high. The reader who waited for this lower low entered late. The reader who saw the lower high kept most of the gains. 3 things to carry from this chart. Capitulation is a price and volume signature, never price alone. Recoveries from capitulation often distribute rather than extend. The worst is over is the most expensive thought in these cycles. And equal highs at supply are the bearish mirror of equal lows, just as reliable and far less watched. Read enough of these cycles, and the recovery stops looking like safety. It starts looking like the setup it usually is.